All right. Good morning, everybody. It's going to be a short week, as I mentioned last week. This happens every year, so you kind of just get a feel for it after a while. It will be Monday and Tuesday, off Wednesday, and then Thursday and Friday. On Tuesday, it's going to be a half day, and if you trade futures, Christmas Eve, Christmas, let's try that again. New Year's Eve at 6 o'clock. New Year's Day, Wednesday at 6 o'clock p.m. Trading will resume, right? So that was confusing as heck. Let's try that again. Tuesday, 1 o'clock, markets close. All of the rest of the night into Wednesday night, and then at 6 o'clock p.m. it'll open up just like a regular 6 o'clock p.m. open. So technically, while we're off Wednesday evening, markets will resume into Thursday and then into Friday. And next week will be just a normal week again. You can always check this. There's an app that you can get that you can put into your Google Calendar or your Apple Calendar that'll give you every known economic event for the year, including the holidays and the trading hours and when bonds are going to be open or not, or futures are going to be open. This is something, if you want to be a day trader, you should know this. You should know how to find it, how to anticipate it, predict it. If it's your first year, hey, congratulations. If it's your third, fourth, fifth year and you still haven't figured this out, you might want to put that on your New Year's resolution things to learn list. So, looking at what's going on around the world, it doesn't appear that we're getting the Santa Claus rally at this point. There's been a lot of talk about this massive run up through the year, how far the S&P went, names that beat the S&P and by how much, and the threat of profit taking in the new year. But then we also have performance chasing. If you think back over the year, how many funds, firms, companies kept saying, now it's a bubble, we're way overbought, we don't like it, we see all these risks, we think it's going to reverse, and it just kept going higher and higher. All those funds and firms and money managers who couldn't beat the S&P 500 this year have to go to clients and explain to them why they should stay on as clients. I mean, if you manage money and you can't even beat the S&P, why would your client stay with you? They could just go buy SPY and save themselves a lot of money management fees. So, there's a lot of competing interests. You've got so many different funds and firms out there, CTAs, VC funds, buyback programs, ETFs and balancing portfolios, fixed assets. It's an endless list. When everybody is all on the same page, it's when everything gets scary, right? We got a highly correlated market structure and everybody's all doing the same thing. It can drive us to extreme moves in the market. That it just entices a flight to safety. And it would only take one big market maker, one big market mover to abandon ship or begin to rotate that could, cause an exodus. But we haven't seen it. So we're down a little bit, yeah, but it's only a little bit. It's not by much. We're not hitting the risk parameters that would, make you think it's all going to come undone yet. But there is a phrase that I absolutely love, and I think she should coin T-shirts or hats or something that go with this. Markets don't crash from overbought positions. right? So when we're at all-time highs, we can fall from there. We can, flip over, roll back, fade, but markets don't crash when they're overbought. They crash when they're oversold. That's when things really get nasty. So when you're looking around in the market and you see that we're down some, if we're not, oversold and pressing to the extremes to the downside, there's no crash there. The NASDAQ is down 0.5%. Hong Kong is flat. Everything else is in the middle. So we go from 0 to negative 0.5%. I mean, all told, that's not bad at all. We're just kind of holding the line, stabilizing, looking forward into the new year. There's a lot of bricks in that wall of worry, to be sure. A lot of reasons for concern, and there's nothing wrong with being cautious, but that's why we trade things that have options so that we can protect those stock positions that we have. So we're getting some home sales data today. Nothing really big on that front other than what home sales can do to the market, but it's not a big one, right? It's not FOMC or non-farm payrolls, but it is something that can cause an impact. Once we get through that, the rest of the day is pretty laid back. We have some auctions at 11:30. There's 3 time frames for an auction at 11, 11:30, and 1 o'clock. And if you see auctions on any of those 3 time frames, just assume the other 2 have time auctions as well. So it says 11:30. Look for 11 o'clock, 11:30, and 1 o'clock to provide a little bit of volatility in the market today. Those auctions are tricky. A lot of times there won't be anything at all, and it's just another day. Wouldn't even notice that there was an auction. And then sometimes, boy, they come in with a fire and vengeance. A lot like the EIA report, Wednesday crude oil report that we get. That thing, it'll go weeks without doing anything and you just get tired of looking at it. Of course, as soon as you quit looking at it, that's the day it moves the market. So these don't get a lot of attention, it seems, but I always give them the respect due. We got auctions today, so keep your eye on the clock. This is finance juice. You don't need to have a paid account here, but if you don't have an account, I encourage you to get one. It's free. It doesn't cost you anything to just open a free account. You could go here without the free account, just go to their website. But if you get an account, it'll remember you and it'll remember your settings. And then you can use the filter. And this is a news aggregate website. It gathers news from all over the place, which sounds great, except it's getting news from all over the place. And you want to be a little particular about the news you get, right? If you're like me, maybe you don't want to see CNN, Fox News, MSNBC. I don't need that trash in my data feed cluttering everything up. Turn that off. You can do that with a free account. It doesn't cost you anything. So we can see the market wrap for Europe. Europe's not closed yet, but they know we're coming in and we need to know what happened around the world. So they do this for the US people. They give us that market wrap early. They'll do the same thing for the US after we close. They'll do another market wrap. So if you're ever wondering what the heck moved us today and you're trying to figure that out, come and see what they had to say about the day. See if they give an explanation as to why the market moved a particular way. They don't always have an answer because sometimes we just don't have answers. But a lot of times they do. They'll also do a pre-market wrap. So they have a little post that you can click on and it'll tell you what's on the agenda for today, who may be speaking if there's any Fed speakers. this should definitely be a site that you stop at every single day and then watch throughout the day, because if anything happens that they think may be market moving, they'll post it with a bright red background. You can't miss it. It'll get your attention, and it can save you if you're trying to day trade. It can save you from getting chewed up. This is kind of cluttered, but that is the ES futures. And these are automatic indicators that are on here. I didn't draw these out. So a really wide rising wedge in this green background, and its target is all the way down here under 4,800. There's an automatic Elliott wave built into this thing, and its targets are down here at 55, 56, 57 and a half. These are levels just measured from the Elliott wave. Now, it's all predicated on breaking this low and getting new lows. We have to do that. And right now we're in a kind of a precarious situation. We have to either come up and break this high and get a higher high, or we need to come down and break this low and get a lower low. One or the other. And we don't know which one it's going to be. That's the fun part. Now, this one big bar here from the 18th, we made it through the halfback, and we got close to that bar's open. We just weren't able to get through it and back up to the top, which is also a cog line, or the open 6132 cog. And we sold off from there. That puts us in a complex topping pattern starting position. It's not yet a complex topping pattern, but it's the start of one. And what we do next is going to define whether it is a complex topping pattern or not. So what could happen is like back here, where we just run up, we pulled over, and then we ran up some more, right? So we could just fade back, pull back right into this zone, and then just come right back out of it again. We could. The problem is on this run up, if it was going to be exactly like this last one, where we just dipped and kept going, then it would have dipped and kept going. It didn't do that. It failed to even get there, and now we're to the downside. So I've already had a lot of people this morning say, what do you think is going to happen? Are we going to make it out of this and continue to rally, or are we going to break down? Is it going to get really ugly? You, me, nobody else can answer this question until we get out of this range. We have to get out of the range. If we're not out of the range, all you're doing is guessing and speculating. I can do that as good as anybody else, but you got to own it and at least say it for what it is. I'm guessing and speculating as much as you are. If we don't get out of this range, your guess is as good as mine, right? If we're taking odds in Vegas, you might as well just take odds. There's no setup yet. What we can say is we've broke underneath this candle's low, so we're inside day breakout with a little expansion. You know, that's not giving you an opinion, that's just fact. We're inside day breakout. So put a Fibonacci on that thing, tie into a 111 or a 1236. That would be a reversal point if we're going to get it. It would be off of that 111, maybe off of the 1236. The problem with the 1236, if we don't turn around at the 111, is that we're underneath that low that I was talking about. Put it back out here. It's not the low, but it would be underneath this low. And it shouldn't even have been this weak. It should have just run up, tested that high. It's a key level that it needed to get through. It didn't even get to it, let alone through it. And we've already started to fall away again. This really looks like a market that fell down and had a dead cat bounce, rally into resistance, and now it's rolled over again. But until it breaks this structure and gets new lows, then we don't have any forward outlook other than, day trade is day trade. That's simple enough. But the whole where do we go from here thing, who knows? Got to break that low. So the other piece of technical analysis, we have a high, higher lows, higher lows, higher. So right now, if this turns around and goes up without breaking this low, it is yet again another higher low. And we've had higher high, higher high, higher high, higher high. If you have higher lows and higher highs, you have a market that's continuing to trend to the upside. That's what it is doing. Kind of get the idea, right? I can just keep snapping it back all the way into that bear market that we came out of. And it's just been a consistent, persistent rally since we've come out of that bear market. So I don't have the answer. You don't have the answer. We got to watch the Fed, the dollar, the yields, and we got to watch these key levels to see what it looks like when and if we break a new high or a new low. Then we've got a more constructive, forward-looking outcome that we can deal with. We are at S1. That's where we dumped in that fall. The pivot point is in purple, 60.32 cog line. Yesterday's low was broken. I know it was Friday, but just keep your linear thought, right? Yesterday's trading, the previous day's trading. So we broke yesterday's low. We're testing S1. If we're going to reverse, it has to be here, right? The problem is this isn't the sort of candle pattern for a reversal. We didn't trend down here. This is one time framing waterfall play here. We're just falling. So we can V bottom back the other direction if whatever caused this spikes us up in the other direction, but we're down 1%. When markets are moving like this, everybody's trying to exit at the same time. Nobody's buying here. If this puts us in negative gamma environment, even dealers are going to be selling into this selling because they need to get back to delta neutral. Normally they would buy into this selling and that would stop us from falling too far. But if we're in negative gamma, they won't buy, they'll sell. That adds to the selling and the selling can pick up speed. That's where we get, say, outlier moves. So S1 and then S2 is down here, 59.23. So looking at last week's low, 59.65, we just tagged that. It's something that we can put a fib on. And that gives us 59.5 for the 111. We could overshoot this, get down into the 111, and then begin to rebound, but that's for the whole week. Otherwise, if that doesn't hold, we have the FOMC week. That isn't really offering a lot of insight there. That 786 isn't going to help us out. $59.50. So where we fell and turned is the full day's ADR. So we got an ADR half in red here, and we got the full ADR down here, 59.63. We got there, we turned around. That's now the line in the sand that we need to hold. Now, generally speaking, if we get to one ADR in the morning or early in the day, we say we can go to the other ADR by the end of the day. But that's usually what we say when we get to the red one, not the yellow one. So while technically it's still on the table, we got to one ADR early in the day, we can go to the other one. We'd have to get all the way back up through all of that stuff that we broke down through, and then get back through VWAP, a voodoo line, the 10-day moving average, 20-day moving average, and then get into 60-50, big round number, and get to that ADR half on the other side. It's possible. We don't want to say that it's not possible. It's just hard to see it coming through on the table at this point. We would need some really good news to flip us back around and do that. Otherwise, we are on the 10-week, and that kind of needs to hold. We can see today's central pivot. There's actually two pivots there. They're just lined up on top of each other. The week's pivot is kind of narrow. I'm going to expand this a little bit so we can see it more. The week's pivot is this lighter channel back here. It's like 5 points wide. For a weekly channel, that's really narrow. The day's channel is here, this bright yellow one. It's a wider channel. It is higher than the previous day's channel, which is considered a bit bullish, but price opened underneath it, which is mildly bearish. Of course, then we just dumped, and we're underneath both the weekly pivot and the daily pivot. And of course, that puts us in a bearish bias. It's another thing that we would have to rally through if we're going to try to make a run to the upside. And at this point, it's not looking very good with that waterfall on the table. We really don't have a lot down here to help us out. Got a round number, 59.50, and a little bit of trading structure around that 59.60 area. And if we look back, we had some history there mid-November. Other than that, it's a nice air pocket down to 58.50, 5800. And we could get, some accelerated flows to help push us in that direction. They're not hedging it yet this morning. Whatever it is that sparked this, they didn't see it coming, or they would have been hedging into it, which is usually how it goes, right? When markets can see something coming, they can hedge in advance, take their time, get things that they really like, get the kind of protection that they really need, and then you're not caught off sides. It can go up or down. You don't care because you're covered either way. But when you're not covered in sufficient quantities and then it just starts to move, well, then everybody's all scrambling to do the same thing at once. and you get exaggerated moves to the downside or upside. All right, we talked about this profile last week and how we're looking for more candles off of the left side here to disappear. That's going to make this point of control move, and that it's very likely going to move into this 60-20 area. It's going to be there more by default than anything else, right? We haven't stayed in one location long enough to have a profile of size anywhere else. So by default, it's going to move down into that 60-20 area. Well, what that would look like if we just continue to scroll this across is something more akin to this, and the point of control would be right here in this 60-15, 60-20 zone. With the kind of moves that we're seeing today, if this continues to fade down and say we hit an iceberg around that 59.50 area, and it's a really large amount of volume structure, that could be enough to build out something that looks like that down at this 60.50. But that's just conjecture at this point. We have no basis to know that there's even any liquidity there, let alone that it's going to turn us around at that point and that we would hold the line at 60.50 or 59.50 and build out volume there. So the idea last week was that we would see the point of control move down into this 60-15, 60-20, and that we would be above it and have it as a springboard for our next leg up. Well, now we're underneath that. So what it looks like instead is that we're continuing to move to the downside, and that behind us, we're continuing to bring a point of control down that's going to continue to act as a resistance, stopping us from going back up. It kind of puts it into perspective, doesn't it? So we've gone through this before. It's a good question. Markets have to behave this way just from the idea that if it gets negative and it does what a new trader thinks it would do, it would just crash and burn, right? We can't have a market that does that. It would just freak everybody out. Nobody would ever trade. So it's got to fall gently, if that makes sense. So if you go back in the past, I'm not going to spend a lot of time on this because you can do it on your own. Go back in the past and just, spread out a couple of years. And of course, you're going to find economic events or, global events that really rocked the market where we waterfalled. But most of the time, if you look at it, areas where we had a down market, it was a market that moved to the downside a little bit at a time, like that bear market that we just had a few years back. It started in January. We fell a little bit. We ran back up. We fell some more. We ran back up. We fell some more and we ran back up, right? It's two-sided trading. And it gave everybody ample time to get out of their portfolios in heavy size, right? Keep a little bit if you wanted to, but it gave people time to exit. It offered an off-ramp. That same market structure, even if you zoom in, you'll find it's the same thing, right? Even in all of that, in the smaller moves, there was still a little move to the downside and then it came back up. And if you take that even one step farther, it did it on the intraday too, right? To where it closed here, gapped down, rallied back up. See the same structure over and over and over and over again. So, yep, this move to the downside, it's just one piece. There's still going to be a leg back up. I wouldn't freak out. It's not much of anything, just another move, right? Now that phrase, markets don't crash from overbought, but they do from oversold, or they can. If we move really far, really fast, then we are considered oversold in the short term. And that's where you can get a short-term exaggerated move and a little mini crash, flash crash. So we had a VPOC from back here that got taken out Friday. We don't need that one now. It's off the table. We don't need to carry it forward and put it on Friday because we've already cut through that level too. So we don't need to replace anything. We still have that 6,100. And so far this morning, the TPO and the point of control, they're both in agreement. Although there's more trading, there's more volume at this low that we're at and less trading with that volume. So that kind of implies there was some pretty good size when we got down there. We fell down into an iceberg. Kind of saved us for a moment. That'll make us pause, but it won't make us rally. We would actually need active, aggressive trades to come in to make us rally from here. So far, this is setting up like a classic P-shape profile. If you've gone through the books yet or studied anything about profiles, got your classic P-shape with the point of control running through it. But it's an early profile and the day isn't done. So, don't want to judge it at this point. All right, so on Friday, we looked at the new week's weekly range, and I left the box on there just to show the size that was projected. Looking at what we actually got versus what was projected, it's not bad. So the actual range is just a little bit wider than what the projection was. That tells us throughout the day on Friday, volatility increased a little bit so that into the close, the new week's range was a little bit wider. That's all it tells us. Now it looks like we're going to get the entire week's range movement in one day. It's not the first time we've done that. It's happened before, certainly. But from the open, we've run most of the way down to the red line, 59.45. Now we can overshoot that. We've done that before too. But the base case argument is that we close inside of this range at the end of the week. So even if we get out of the range, 80% of the time, we're going to come back inside of it and close on the week inside that level. We are above the 10-week, but just barely. I have to zoom in for you to even see it. It's that tiny little bit right there, and it's getting more narrow by the moment. So we're basically on the 10-week at this point. The problem with that is the 10-week can act a little bit like gravity. Once we get near it or close to it, it just draws us in like a magnet, and now we're there. It's going to take some solid flows to get us away from it now. On the one hand, that's good because it can stop us from falling farther. But on the other hand, it's bad because it can stop us from rallying back up on it like a dead cat bounce or something. Obviously, it can't keep us here forever because we've been around the 10 before and we always manage to escape at some point. But that's the thing. We're going to need the velocity or the inertia to get out of this. It's unlikely that we'll get that before the open at least. We may need some news or a catalyst to get it done too. Unless we're just going to continue to drive to the downside on the idea that this pause that we have at the moment is nothing more than profit taking in the drop, and we're just going to drop some more. Yeah, that's a good one. When I see that's good. When I see this sort of movement, my usual reaction is, okay, who broke it? Which one did you push the button? I told you don't touch anything. You broke something. Yeah, that's good. You got to laugh a little bit, right? So we're down below the 10-day, more than 1%, closer to 1.25. We've been lower than this before. Even this year, actually, we've been lower than this. It's not necessarily a good thing, right, to be under the 10-day, but it doesn't break the system by any means. So it's not extreme enough yet to consider the idea that it owes us some sort of reversal or a flip back in the other direction. And we're not overbought and oversold. As I don't like the phrase overbought and oversold. I use it when we have to, to provide context or to quote somebody, but it just gives traders, new traders, the wrong idea, as if, what's it mean by overbought? Well, we've been buying so much that there's just no way they can buy from here. Well, that's not true, right? We can get overbought and stay overbought for weeks and months, or oversold that we've sold so much there's just no way we could sell lower from here. And of course, that's not true either. We could just keep selling. So I don't like the phrases when I can help it, but a lot of times we just don't have any better words to replace them with. So at these lows, we're 1.25% below the 10-day. That's not oversold enough. When we talk about we can flash crash or markets can crash from an oversold condition, is this oversold enough? Not necessarily, no. I think the missing key piece would be the dealer gamma, GEX and DEX, and where is the zero gamma level and the volatility trigger, and we're underneath those. And that's the key piece. Not how far necessarily we are from the 10 on an hourly, a daily, a weekly, a 15-minute. It's, are we in negative or positive dealer gamma environment? And are they going to start to buy as we fall, or are they going to sell with the sell and really make us fall? And this is saying that they're not going to come in and play save a hoe because we're in negative gamma. Now, as we sit here, it's not suggesting that dealers are going to start selling from here. Just that if we break that low and continue to go lower, they won't buy into it. They'll sell into it. So they won't make the fall. But they'll sure sell while we're falling. It may be a nuanced difference, but there is a difference. So until we get below 2 or maybe even 2.5% below that 10-day moving average, I wouldn't get too concerned on the swing trade point of view. And, these sorts of swing trades would be less than 3 weeks sort of thing. For your bigger picture 3 to 6 month swings, this shouldn't even be an issue. It shouldn't even be something you look at. All right, and for the capital rotation, yeah, there are these really nice bear flags on more than half the market, and a dead cat bounce on most of the others. We were talking at the start of all this about a highly correlated market structure when everything everywhere is all doing the same thing, all going down, all going up. So if all of this gets into sync, then the exaggeration up or down can be exacerbated. It's a fun word on a Monday. All right, so we got China down, the Mag 7, uranium, Bitcoin, chips, software, growth specifically, more China, financials. There's 3 sectors that we look at for a risk on or a rally day: finance, technology, and consumer discretionary. All three of those in all forms that we would look at are down this morning significantly. If we're going to get a rally today, that has to change. Not even just stop falling, it has to straight up start running. And we don't have that yet. I don't think options alone could even change it at this point. So watch the chips, watch the Mag 7, the consumer discretionary names, the NY Fang group. Because you don't want a rally on pot stocks and nat gas. What do we have up this morning? Nat gas at 16%. XLF is down, but banks are up. KBE. XLF is a generic form of financials. It can have trading firms, credit cards, lending institutions, everything, which, you know, includes things like PayPal and others that are in Bitcoin. KBE, on the other hand, or just banks, KRE, KBE, that's just banks. That's a completely different beast. Oil. Interesting to see that bonds are up a little bit, but they're not even breakout yet at this point. If we bring it over onto the daily and we look, we got nothing in bonds. This has a long way to go, even just to get back into a normalized state. We haven't even started to turn around yet. So on the shorter, smaller time frame, we're still inside day. We got to get above 88 to start that failed flag formation and start to form a big cup here. It would take weeks to form that cup. And then pot stocks. You're not going to get a market rally on nat gas, crude, bonds, and pot. Even options in the S&P and the NASDAQ won't be strong enough to turn this around at this point. We have to get those other names to turn around. And to do that, we're going to need some catalyst or market move, right? Some kind of news. Carter passed away over the weekend, and generally, if a president dies, they stop the markets from trading. But he was president in the 70s. You know, we're talking 50 years ago almost. And I don't think they're going to shut the market down for this president. On the one hand, I mean, as a trader, I want to trade. So I'm glad that they didn't turn the market off. But on the other hand, it's just, it'd be nice if we stick to traditions. You know, we're losing more and more of those, it seems. So watch the clock, keep your eye on the news. If anything is going to turn this market around today, it will be news. There's no market structure alone that can flip the script here and bring us back in the other direction. It has to be news that brings us back around. It can be even trumped up news, right? It can just be sentiment structure. Like if they all start the whole rah rah, I think it's going to be fine thing, and maybe a few Feds come out and chip teeth and flip it around. Maybe, but it's going to be some sort of sentiment driven structure. Otherwise, just get everything off of the chart, mark it from the place where it started to fall. That'll be your liquidity gap to get back to, especially if it lines up with a new hour or even a quarter hour. I guess 605 here, but actually I like 6,000 better because it lines up on the time frame too. You can take the entire thing put your 786 on it. Should have done that the other way around. $59.24. So there's your bear flag, and we could chop like that for a little bit and then continue to the downside. That's what a bear flag does. Or we can get a failed flag, and we start to form a big old cup, right? We're thinking about a cup and then a handle and then a continuation. So get a big old cup. If we can get above 786, the target is the half, 59.92 cog line. If we can get above that, we've got liquidity and structure at 6,000. And then the 60.11 cog line, and then back up to where we started, 60.16, and get above that. Level by level, piece by piece. Otherwise, if we don't bounce, we got our lower targets here. 59.50 is the OCC, opposite candle color. So red to that point, get an opposite candle. Then we would move the line. Once we got an OCC there, that would be our new 786. And then our next lower level, 59.32 cog line. Couldn't make that up if I wanted to. That the next measured move from 59.50 is right to another cog line, 59.32. Step by step, level by level, right on down we go. Guys got it. Be careful, be safe. I'll see y'all tomorrow.